Hi, my name is Roger Schluter. So anyway, this video is about business loan definitions. Now, sounds kind of boring. It is, but a lot of times I remember talking to people and my wife was around and she'd go, you're speaking this jargon and you're mentioning people's names and doing this. She goes, they don't know who these people are and they don't know what those terms mean. What are you doing? And so a lot of times I have to sit back and go, I'm talking to people. I'm talking to people about loans. Half of them don't know half the words I'm speaking. And a lot of times they don't know the definitions for these. So anyway, I'm doing this video just on definitions. Now this isn't going to be an end all. This isn't a 300 word deal, but there are going to be a lot of the terms that you're going to hear in lending and in basically commercial lending. So I'm going to give you an idea of what they are. So anyway, business loan. To a bank, a business loan is kind of they're talking about the total cost. They're talking about the business, the loan, but they're also talking about equity. And they do want you to have some equity in the loan. Conventional loans can have 20% plus equity. A lot of times SBA loans, they just want 10%. So anyway, the whole loan to a bank is really the loan plus the equity, and that's really the total project cost, I guess. Loan term. The loan term is how long the loan is, whether in months or years. If you think of your conventional home loan, it's a 30-year loan. So that's the term of the loan. Loans can be shorter. They can be a 10-year loan. So anyway, that is the loan. The maturity of this loan is when it's over. It's when the loan itself is over. Now, it could be over in a number of ways. It doesn't necessarily have to be paid off. And I'm going to get into that in a minute. Collateral. Collateral is things of value that you pledge as collateral. So if your business bites the dust, the bank can liquidate that collateral and the bank can go ahead and pay this loan off. Now, collateral is a pledge. It's a pledge that you give. You're also going to have a pledge of collateral, but then you're also going to have a guarantee. And a lot of times that guarantee that you sign is actually supported by that collateral. So anyway, the collateral, it's a pledge that you make for the collateral. Now there is such a thing as a negative pledge. And a negative pledge would be as if you had an asset that you weren't going to encumber with any bank or lending institution. So your bank wants to make you this loan, but this other asset over there, they don't want you to get a loan on that too. So they'll make you sign a negative pledge on that particular asset so that you won't pledge it to someone else with a loan. And, I didn't find out that one until I worked at a larger bank for a while. So anyway, the interest rate is the percent that's charged per year, the interest rate of the loan. Usually these are equated with the prime rate. The prime rate is what most banks give their best customers. Now, some banks, I've seen banks go under prime for their best customers, but that's what prime is the definition is really most banks, they give a prime rate loan to their best customer, and that is quoted in papers, and you can get it online. Just look up prime rate and you can get that too. Now, the effective rate is different. It is actually the interest rate. But if you have fees and you have points that are charged, what it does is that effective rate incorporates those fees into that loan. And if you held everything else steady, the only thing to move would be the interest rate. The interest rate would go up in accordance with that. And I think the rule of thumb, don't hold me to this, I'm pretty sure the rule of thumb is something like every point over a 20-year period would be equal to a quarter of a point in the loan. So anyway, there is the guarantee, and like I just said on the collateral, a guarantee is something you sign. You may pledge collateral with that guarantee, or you may not. The guarantee is just say you guarantee, this loan that you'll pay it off. They will usually look at the personal financial statement, and that's another thing, the personal financial statement, to see if you have enough wherewithal and enough assets to pay this off with a guarantee if the business goes out of business. So anyway, your personal financial statement is what you own and what you owe, and it basically breaks it all down into detail. So SBA has a very good one. Most of the banks have good ones also. Banks sometimes will have shorter personal financial statements. So a lot of times, you know, with an SBA, you can still use the banks or the SBAs, and we usually tell them to use the banks. So anyway, the amortization period is another good one. Amortization period is, we're going to amortize this loan like it's a 20-year loan, and we're going to say we're going to amortize it over 20 years, and that's going to be your payment. But the loan isn't going to be for 20 years. It's going to be for 10 years or 5 years or 3 years. So, but you'll make payments like it is a 20-year. And then at the end of that 3-year, that 5-year, that 10-year, you're going to have a balloon note that's going to come due. And then you're logically, I guess the bank could say, hey, see you later, pay this off, sucker, find another loan. But usually the bank will go ahead and make another loan of another 3 years, another 5, another 10, whatever. And they'll continue to do that until it's paid off. But you'll make payments like this is a 20-year loan. So that's amortization period. Default. Default is you decide you're not going to pay it anymore. You quit making payments. That's default. You have defaulted on the loan. A lot of banks have a lot of different ways you could default. But usually it's you stop making payments and the loan is in default. Projections. Projections are just well, let me go financial statements first. Financial statements are income statement, balance sheet that the business has. The income statement shows sales, expenses, and then net earnings or net income. And then the balance sheet just kind of shows, you know, what the business owes, what assets it has, liability owes, and how much equity it has in the business. So anyway, the projections would be you're projecting, and usually it's more equated with income statements than balance sheets, but you're basically projecting this balance sheet or this income statement, usually for a year and usually for several years. So you'll do it for 1 year and then you'll do it for the next year and the next year, usually for a 3-year period. And you have to have assumptions. Most people don't. They don't have assumptions. They have no idea where these numbers came from. The numbers can come from historical financial statements that you have, and those are usually the best. Those are what I rank highest. But a lot of times with a new loan, you're just going to have to base them on something. You got to hang your hat on something. And banks want you to hang your hat on something. They want some assumptions to show these projections are realistic. You've got prepayment. Prepayment means that you can pay this loan off faster than your agreed upon term and interest rate. So prepayment would be, hey, I've got a 20-year loan, but I want to pay it off. 5 years have passed. I got some extra money I got from somewhere. I want to pay this sucker off. So banks may allow you to do that. Some banks don't. Some banks depend on that income over those number of years. And so some banks will have a prepayment fee. And that usually it's somewhere between like 1% and 3% or 1% and 5%. But it can be based on different things. So, you know, that is one thing you want to find out. If this loan, can I prepay it? And if I can, is there a prepayment fee? And what is it? Because sometimes it depends on other things, depends on other interest rates and stuff. SBA, Small Business Administration, they are a federal government entity that makes loans. It doesn't really make loans anymore. It basically guarantees loans. And then it also, on one of their loans, the 504, it actually, helps in the sale. It does guarantee the sale of the debentures that are used to finance part of the loan. But normally it just guarantees loans up to 75%, can do it up to 90. Usually it's 85 for small loans and 75 for larger loans. RMA. RMA is the Risk Management Association. They have actually books called statement studies, and you can get this online too, but they're I don't know, I think they're kind of pricey personally, but most large libraries will have the RMA, Risk Management Association books. And they're the statement studies, and what they do is they take all these statements in a year from all these different industries and different businesses, and they put them together in industry clusters. Like if you had a car wash, they would be able to tell you, now the sales are all 100%, but they would be able to tell you what all the expenses are. Cost of goods sold, what normally are the expenses of a car wash and what percentages they are, and what net income that car wash would make also. So that's RMA. We would have the cash flow. Cash flow of a business is normally the net income or net earnings, and then they want to add back in any non-cash charges as like depreciation, or and those are stuff that is a little, it could be a course in itself really. So but cash flow is money, is cash money that the business generates. Debt service is your debt service, usually for a period, usually for a month or a year. Normally they will equate it to a month, the debt service payment for a month, and then banks will extrapolate it for a whole year. So they just multiply by 12 is what they do. So anyway, and there is such a thing called a debt coverage ratio, where you take the cash flow and you divide it by the debt. And think about that. If you've got the cash flow, you're dividing it by the debt, if they both equal one another, it's a 1-to-1. Now that's what we don't want, because a 1-to-1 is the cash flow is just going to pay off the debt. What you want, what banks want, is a 1.2 to 1.3 debt coverage ratio. SBA will do with a 1.1, but higher the better. I've seen businesses with a 3 and 5 to 1 ratios of debt on the debt coverage ratio. We do have, and now we're kind of going, if we go to the, let's go ahead with the, I kind of explained what financial statements were. They were income statements or balance sheets for usually a year for a business. There also is an interim financial. The interim financial, you normally get financials for a whole year, like for a tax return. The interim financial will be for part of a year. It'll be for whatever part of that year is. So let's say right now let's say it's September. And their interim statement would be January through September. If you're on a calendar year, it'd be for the 9 months. And so that's what it is. An interim statement is for a less than 12-month year, usually to see, you've got the 3 years, but you want to see how they're doing this year. So you ask for an interim financial statement. We also have some balance sheet ratios. Working capital is, I think it's current assets minus current liabilities, and it shows you how much capital you have to work with, kind of, after you pay your bills for this year. You've got the current ratio and the quick ratio. Current ratio is current assets divided by current liabilities, and usually it's between 1 and 2. If it's below 1, that's not good. In a lot of companies, it'll be closer to 2. And that's just a liquidity ratio. It just shows, the assets to liability. And then the quick ratio would be the liquidity parts of the assets. So it'd be it'd basically be the cash, accounts receivable, and then they would divide that by your current liabilities. So what are you leaving out? You're basically leaving out inventory. So inventory is not a very liquid thing. So anyway, they leave that out for the quick ratio. Quick ratio is also called an asset ratio, meaning that this is kind of this is what you're going to get in cash, our liquidity, if you had to liquidate the business. This year, that's the way it's going to end up. And usually they want that at a 1. Usually it's not much over 1. But then again, less than 1 is probably not good for the quick ratio either. So that's a pretty good, I think the one that I forgot was credit score. Your credit score is going to be with one of the rating agencies, either TransUnion, Equifax, Aspirin. Those are the big 3. They're going to give you a score, a credit score. And a lot of times when you check your credit, they make you pay for the score. Credit Karma, you can get that and they'll give you a score. I find they're not exact, but they're pretty close. So you can use that one to get an idea where you are. Credit score is a, if you're 700 or above, banks don't hesitate to give you a loan. And that is what they consider good credit. Closer you get to 800, closer you get to fabulous credit. When you get under 700, probably, I think it used to be a lot lower, but I think right now they would like to see at least a 670 credit score. And a lot of banks, they'd probably let you go with 650. But they really don't want much lower than that. And then if you're in the 500s, just pretty much forget it. Unless you've had a really bad incident and then you're building back your credit. A lot of times SBA will do a deal if you've even had very bad things happen a couple years ago, but in the couple years since you've done really well and you've controlled your credit. So then they'll go ahead and a lot of times let you do it. But that is credit score. So those are a lot of the words and the definitions that are used in banking, at least for loans, for commercial loans. I'm sure somebody will write down all this list, and number one, they'll say, why don't you put it alphabetically? Well, I kind of wanted to group some of this stuff together. I don't know how well I did that, but and then the other thing is, I don't want it to be like a one of these lists where these obscure things don't mean anything. So anyway, that's the business loan definitions, business words, and hope you get some value out of it. You probably will if you are new to lending. If you're somebody who's done a bunch of loans and you talk to banks and you know bankers, you're probably going to know a lot of these terms, or you've looked them up already. But if you're kind of new to this stuff, or you're a new business, you may not know what a lot of these words mean or these definitions are. So anyway, thank you very much. That's the end of the video. If you got any value out of this, I hope you hit the like button. And then again, if you want to hear more content like this, hopefully not quite as boring, but a little more exciting, go ahead and hit the subscribe and hit the notifications bell. Thank you very much. Appreciate it. See you next time.